Today I'm going to primarily focus on the stock market, what's going on and what's coming, and Mike Wilson's view. He's the chief U.S. equity strategist for Morgan Stanley, his views, and then I'll give you my comments after that. I'll cover a little bit of economics, but mostly it's focused on the stock market. The reason for that is I think that's what most people want to know about. Hi, my name is Ben Reppond. Welcome to my YouTube broadcast. Today is March 28, 2023. As I said, I'm going to cover Mike Wilson, and the reason I'm covering him is because he is more focused on the micro or the short-term view of the market. I've covered some who are more macro, looking at longer-term cycles. But I think in talking to people, they're really interested in what is happening. I want to know about my investments. How safe are they? Where's risk in the market now? Meaning for the next month, the next quarter, this year, not beyond this year. So Mike Wilson has done an excellent job at putting that together. And the other reason I'm covering him is that he's available, so I get a lot of material on YouTube from him. But the other is that he's been extremely accurate. So his predictions of this is what I see coming, when you go back, I'm just focusing on the last year and a half, but I think even before that, he's been very accurate. The reason for that, I'll describe that later. But the first video I want to cover, or the first segment, is where he's talking about that we're in a bear market, and a cyclical bear market. And in a cyclical bear market, what happens is the market goes down and then it tries to go back up. That's called a head fake. And then he even refers to it as head fake. And then it collapses and goes back down, and so forth. That may make sense to you, but what's been happening for the last 14 years is that we have not been accustomed to that because we've not been in a bear market. We've been in a long-term secular bull market. So people have been used to, when it goes down, you just buy it and it'll go back up. And the opposite is happening now. So this is really fooling and frustrating investors and even probably many investment managers. So that will be the first segment. And the second segment I'm going to play, I'll describe that later, but let's go through the first one and then listen to what he has to say.
And that to me is classic price action that we do see in bear markets. Bear markets tend to, have these bear market rallies, for example. The declines tend to be somewhat vicious and don't always make sense fundamentally, because in bear markets, what happens is you see deleveraging. You see, active managers and passive managers doing things they don't necessarily want to be doing, but have to do. And that creates this, what I call hall of mirrors, where you see something and you say, oh my goodness, well, that price action looks pretty good. And the reality is that may be a head fake. Now, it's not always the case, but, when I wrote the line, I think it really did describe what people were feeling from a client perspective. And, quite frankly, I think people somewhat agreed with it. It's been challenging, and it continues to be challenging in that way.
Now, this is really interesting. And the reason I'm going to play this and kind of unpack it for you a little bit here is that he goes through their methodology on how they determine what's going to happen in the stock market. So a lot of times when you get the talking heads that come on TV, they will say, I think this and I think that. I think the market's going down because of this and that. Mike Wilson and Morgan Stanley take a different approach. They have analysts, and their analysts follow certain companies. Now, I don't know the number of companies they follow, so I'm going to speculate. But I think it's at least the S&P 500, so that would be 500 companies. It could be another 1,000 or more companies beyond that easily. And then they interview those companies. They get the forward guidance. Okay, what are your earnings? They know what the earnings are and the revenue and so forth. But they're really interested in the forward guidance. What that means is, what do you think is going to happen this next quarter, this year? And why do you think that? What about profit? What about revenue? What are the risk factors? Slow down the economy. So they take all of that information on every single company. So imagine, let's just say it's 1,000 companies. So all of their analysts compile this information, and then they feed it into a computer model software that gives them a composite picture, but a composite picture made up of the individual components of that picture. A lot of micro components feed into the composite picture. So when they say, I think this is going to happen the next quarter or this year, it's made up of all of that input from all of the constituent companies in the stock market, or at least many of them, the major ones for sure. And they get a very clear picture. Some maybe have a little more optimistic view, some a little more pessimistic, but the composite view is what they're looking for. And so he goes through their earnings forecast, and his conclusion, and this is why I'm covering this, because if you're an investor or you have someone invest your money for you, this is information you need to know. He gives a range. His forecast is that during 2023, the stock market is likely to drop, he believes it will drop 15 to 25% more from where it is right now. Now, he uses numbers based on earnings numbers, and then he translates it. He even says it's somewhere between 15 and 25. I think the lower number he uses is 10 to 15, but the upper number, 20 to 25, drop in stock prices in general. Now, again, some will be greater than that, some will be less than that. So if you think of the S&P 500 just as a composite broad index, you said, okay, if that's true, then we are likely to see the S&P 500 drop 15 to 25% more this year. Now, he gives a caveat to it. He said, if our estimate on earnings is correct. Well, the estimate on earnings he's referring to is not their estimate. It's the input they get from the constituent companies. So it's usually pretty accurate. And there's a number of factors that are playing into it. Silicon Valley Bank, Signature Bank, banking crisis or headwinds. Yeah, there's a number of factors that are influencing that, maybe on the negative side. But he has held to this view since last December, even before this banking situation that we're now facing. So think about how you invest your money. Are you okay with whatever methodology you have, whatever defensive position you have? Are you okay with that if his view is correct? The way we do it is different than others do it typically. We have an indicator, and our indicator is based on people's willingness to take risk, not based on the stock market. So when the stock price goes down, that is not necessarily an influencer of our decision. Our influencer is based on people's willingness to take risk. And when that starts to go negative, then we're out of the market. When it starts to go back positive, we're back in the market. We found that to be a better way to look at risk and look at market exposure. But anyway, Mike Wilson talks about this from the standpoint of forecasting the rest of 2023. So take a listen to Mike Wilson.
We believe that this earnings recession that we're now in, and we called for it a year ago, is early days. And I would say the consensus view 3 months ago was kind of in agreement with us that the earnings were going to be significantly lower than expectations. And now, because the economy is kind of holding in better than people thought, all of a sudden people's view on earnings is not nearly as bearish as we are. So let's give you some numbers. For the S&P 500, we like to look at forward 12-month earnings, right? So FY2, if you will. And it peaked at $240 in June of last summer. It's now down to about $223. That's the consensus bottoms up, kind of rolled up numbers, which is a reflection of company guidance, if you will. Okay, and that's how the markets trade. I would say that the sell side, my peer group strategists, are in the 210 to 215 camp. All right. We're at 195 on a base case, and it could be as low as 180 if we end up having a recession or not, which I still think is a kind of a 50-50 coin toss. And the buy side is probably closer to my peer group, call it 210, 215. So that's a big enough delta where it's going to matter. And we think that those earnings revisions that have been coming down are going to continue for the next 2, 3, maybe 4 quarters, and it's not fully discounted. I think what the buy side and the investment community is trying to do is say, hey, the worst is behind us, looking forward, and the revisions aren't necessarily going to rocket up from here, but they're not going to get any worse. And I think that's where we're different. And if we're right on our forecast, on the earnings forecast, even if valuations stay where they are, which are rich, and we'll get to that in a minute, you've got 10 to 15% downside. If the valuations come down also because they're rich as we think they are, you could have as much as 20 to 25% downside for many stocks and even the major averages.
So this last video was from last week. This video I'm going to show you now, it's a 1.5-minute clip, so very brief. He's being interviewed by Romaine Bostick from Bloomberg. And again, this is from last week, a few days ago. Both of them pretty close together. So his message is somewhat the same. It's just one, it just is a little bit different flavor to it. So I thought it'd be an interesting 1.5 minutes to play this. In this video, he points out that we are not done with the bear market, and that what happens is that the stock market gets ahead of market risk. So when risk is entering the market, when it basically says this still needs to go down some more, people, and maybe investment managers, maybe investors, they think, hey, look, back in 2022, okay, we're done. This is a good price. I want to get back in the market. Particularly if the market starts to go up, it sucks people in. But he points out it's not done yet. Be patient. Wait for this drop. No matter if the market goes up in the short run, we're not done yet. The market has further to fall and is weak. There's weakness. And he even says, hey, I want to be in the market. I want to make money. I want to be bullish. I will get there, but not yet. And that's the way I am. We want to be in the market and make money, but our indicator is telling us not yet. Be patient. Wait for that time. It will come. We don't know when. He talks about, second, third, fourth quarters. I don't know. It may be, we've heard a lot of comments about it being mid-year, but I don't know that. The market will do what it does. And there are other external factors, like this banking situation has come into play, that could affect this. But the point is that the bear market is not done. It's not at its bottom, according to Mike Wilson. So take a listen to this.
I'm curious as to what you look for that gives you more confidence here that the bear market is over, a new bull market is afoot. Is it specifically about economic conditions and economic conditions alone?
Well, no, actually, price will usually lead. Okay, so what we're looking for is price, meaning that the price has never really, factored in the growth concerns, right? That the bear market to date has still been, for the most part, about the Fed, inflation, and interest rates going up in very quick manner. And that has compressed valuations. But at no point in the last year have we seen the equity risk premium component, similar to credit spreads, by the way. Those usually blow out when they're really concerned, when stocks or credit instruments are concerned about growth. And that hasn't happened yet. So we really can't say the coast is clear given our view on growth. Now, if we were more optimistic on growth, then we would probably be saying the bear market was over in October when we called that rally back at that time, because we thought there would be a relief on the rate side, which we got. But now, given our view on earnings and, of course, this potential credit crunch, we think the risk has gone up for that equity risk premium to finally come home and hit the price earnings multiple. So that's the thing we're really looking for, Romaine. And then, obviously the economic data and the rate of change on growth will follow. And we just think people are being impatient here because, look, bear markets are exhausting. Okay, I'm more exhausted than anybody because I've probably been bearish the longest, and we all want it to be over. but it's our job to point out to clients that the risk reward is still not attractive given our outlook.
Following on with this theme around Mike Wilson, I was reading on Bloomberg this morning and read an article, and I'll just give you a few sentences from it. It's a very interesting article they wrote interviewing him, and as of this morning, so this is the most current, so he was quoted. The article says this: Morgan Stanley's Mike Wilson says turmoil in the banking sector has left earnings outlooks too high, putting the stock market at risk for a sharp decline. It reminds me of Hyman Minsky, the economics professor, who had this theory that is called the market instability theory. The more stable the markets are, the more instability that follows. In other words, the higher it goes, the further down it's going to fall. So he continues. Given the events of the past few weeks, we think guidance is looking more and more unrealistic, and equity markets are at a greater risk for further decline. Financials and consumer retailers are among sectors that have already started to decline. We think stock indexes do not look attractive at these prices. In other words, be patient. Be patient. Take a longer view and look for ways to preserve capital today and not expose capital to undue risk. So, shifting gears, I wanted to show you this. This is a slide I got. This is from Goldman Sachs and the Federal Reserve. Forecasting, this is interesting. Okay, but it's Goldman Sachs and Federal Reserve, so let's assume it's correct. The light bars on the far right side of the chart show the forecast of households that will be net sellers of equities in 2023. 700, that farthest light blue bar, that's sellers, the households will be net sellers of $750 billion, 2/3, 3/4 of $1 trillion of equities this year. So he shows the 2022 view and the 2023 view compared to the historical picture going all the way back. So we're not quite at the 2008 level, but we're not that far away from it. You can see that as you look further to the left of the chart. You can see those deep bars going down, and that is 2008, 2009. So in other words, we are in a period where there is still more selling to occur because of people's fear of what the market is going to do. It is probably, like it does in most bear markets, going to rip money out of the hands of investors. Just an FYI. Now I'm going to go over to shift gears a little bit, go over to Moody's Mark Zandi and being interviewed by Melissa Lee. And he's talking about the housing component, and Moody's reviews that segment of the economy. And so we've had a lot of segments of the economy, including recently the banking sector, and break down. And we have not yet seen the employment data break down yet, but real estate is starting to come down. So this next view is Melissa Lee and Mark Zandi, and the Federal Reserve, the increasing of interest rates. What is the impact that this has had on housing? So he's answering the view of the supply side, the impact that that's going to have on the economy and the impact that rates have had on the supply side of the market. So take a listen to Mark Zandi and Melissa Lee.
But Mark, what about for the builders? I mean, I was just talking about how they're going to have to do more construction to meet this growing demand. They rely very much on the regional banking system. How is it going to be for them?
Yeah, good point. Yeah, I was thinking about demand, but you're right. In terms of supply, in terms of the ability of, not so much, I don't think the publicly traded home builders, I think they have access to lots of different sources of capital. So I think they'll be able to get the capital they need. But for the smaller builders, and of course the home building market's very fragmented, lots of smaller builders, they do rely on construction and land development loans, and in many cases from small and mid-sized banks, and they are going to have a hard time getting those loans. So yeah, so the supply side of the market may be impaired, as these banks try to work this through, and may add to your statistic of homes that are sold but not yet started because builders may not get the capital they need to actually start those homes.
How does tightening credit play out in your mind, Mark, when it comes to the impact on the economy and therefore, of course, housing ultimately?
Yeah, meaningful. I think this is a big deal. Small, mid-sized banks, these are banks, let's say, with less than $250 billion in assets. That's the bulk of the banking system. They account for half of all C&I loans, commercial industrial loans. They account for half of all consumer loans. Those are credit cards and unsecured personal lines. They account for 3/4 of all commercial real estate loans. In terms of the housing market, I think the part of the market that's going to be most affected is the multifamily market, in terms of multifamily developers getting the credit they need to put up the next new project. We need those rental units, we need those homes, but they're going to have a difficult time. So, my sense is, Melissa, this is going to shave meaningfully off of growth, and it's probably worth, if we're going to translate this into rate hikes by the Fed, at least a couple rate hikes, maybe 3. I don't think the Fed needs to do now because of the tightening in credit conditions as a result of the banking crisis, and that's to date. I think I hope the script has been written, but maybe not. So, given what's happened so far, I think the credit fallout will be quite material.
So I saw this. I thought it was interesting and humorous, I guess. Mom, are we in the stock market? No, it's all we can do to be in the supermarket. So that's right back to where we live every day. And a lot of people are not so concerned with what's going on in the stock market. They are concerned with what's going on in the supermarket. And that's another story. So thank you for watching. And if you have questions or comments, leave them in the comment section below. Thank you.